coming to you straight from Manila, Philippines. This is Rise of the Bester. Today we're talking about the profitability of Uber and what it means for Grab. Earlier this month, Uber announced their first ever profitable quarter. Nelson Chai, Uber Chief Financial Officer, reported, "The unique power of the Uber platform and the team's relentless focus on profitable growth was on full display in quarter two, with record profitability and over $1 billion of quarterly free cash flow." Uber stock has gone through a roller coaster journey since their initial public offering in 2019. Several factors contributed to this, including lower demand during the COVID lockdowns and a highly competitive market in both ride-hailing and delivery. Uber's stock was hit hard when the market correction began in 2022, particularly given their lack of profitability. So their first profitable quarter is a remarkable milestone for the company. One number stood out in their earnings, that was Uber Ads annual revenue run rate of $650 million. Even though the advertising business has only been around for 4 years, $650 million is more or less 15% of Uber's annual free cash flow. Undeniably, this has been one of their largest drivers for profitability. Since Uber's founding in 2009, the ride-hailing business has grown exponentially. An influx of venture capital money into the industry kicked off an era of heavily discounted rides and regulatory successes against taxi cartels, ending with Uber owning 70% of the US market today. The recent years also saw a steady state emerge in non-US geographies. Uber sold their China business for a partial stake in Didi and continued to maintain a 40 to 50% market share in India. However, the market in most geographies today continues to be a duopoly, and Uber continues to have to engage in price wars given the lack of consumer loyalty towards a particular brand. In fact, despite getting to profitability this quarter, Uber's stock dropped due to concerns about a re-emerging price war with Lyft. In the delivery business, while Uber Eats had a first-mover advantage, DoorDash now has the lead in the US. While this business has grown steeply through the pandemic and now constitutes half of gross bookings, the market continues to be highly competitive, limiting how profitable Uber can be. To break out of the low profitability loop, Uber has made some strategic product investments. Let's take a look at a few. First, they launched Uber One. Uber One is a monthly subscription that provides zero delivery fee and Uber Eats, a 5% discount on Uber rides, and promotions to specific restaurants. Uber says they have 12 million subscribers. On a generous basis, the $10 month subscription generates more or less $1.4 billion in annual revenue, which could be very meaningful, especially if it can make consumers use Uber more. On a conservative basis, 12 million is the current active subscribers at this moment on time, but does not account for how many would churn. Nevertheless, even at a limited level of success, this could make a meaningful dent to profitability. Uber also announced a multi-year partnership with Waymo to start bringing autonomous vehicles into the platform long-term. While this is likely to take a while to play out, it could be a long-term driver for profitability. Uber mentioned another interesting win in their earnings press release. Quote, "Mobility revenue in Q2 2022 and Q2 2023 benefited from business model changes in the UK by $1.1 billion and $1.4 billion respectively." Upon further digging, it turns out that Uber started showing drivers how much they would earn while accepting a ride instead of the total price of the ride. This was done in response to new UK regulation, but the impact was surprising. In other words, changes to how prices were shown to drivers created opacity that effectively let Uber increase their take rates by 8% points, thereby increasing Uber's profitability. Beyond these, the most notable profitability driver for them was advertising. Uber has a few different product offerings tied to services where ads can be shown. On the Uber Eats app, sponsored listings let restaurants appear in front of users when they're deciding what to order, directly tying the ad to the success outcome of Uber Eats transactions. Another Uber Ads product, storefront ads and in-menu ads, allow promoting specific items within a restaurant or business list of items, typically catered towards consumer packaged good advertisers. For example, PepsiCo promoting Doritos when you're ordering from 7-Eleven. Another ads product, post-checkout ads, let any advertiser to show brand awareness ads, including video. In the Uber ride-hailing app, they offer journey ads, videos, or image ads that appear when you're waiting for your or during your ride, and tablet ads on Ubers that have tablets. These formats can be used by any advertiser advertiser, but primarily work for brand awareness purposes. What makes advertising attractive for Uber as a company is that it's essentially a 100% margin product. Ride-hailing and delivery are high-scale but low-medium margin businesses. Uber typically keeps 20 to 30% of the gross bookings. With ads, Uber can create advertising inventory at zero cost and keep 100% of the revenue generated. Advertising does not exist in a vacuum. That is, if there are no users in the ride-hailing and delivery apps, there is no ad inventory to monetize. But in the presence of high consumer engagement, it's an incredibly powerful tool for Uber to generate net new profits that subsidizes the lower margin core business. So how successful can this be? The success of this product depends on being able to sell into a large set of advertisers and scale revenue. Uber definitely has the scale, 137 million monthly users. They also have a robust data to target users based on a variety of factors such as loyalty to a restaurant, cuisine interest, past items purchased, locations visited, location trends, and more. Among the ad services, there is a clear duality. Uber Eats is a cleaner pitch for any performance advertiser. Spend ad money with Uber and measure the value of Uber Eats transactions generated. The ROI, or return of investment, is straightforward, and given Uber Eats market share, this is an easy sell. However, ads within the Uber ride-hailing app is a trickier sell. Uber makes the argument an average ride is about 20 minutes, which means 20 minutes where a person is leaned back and really receptive to advertising. And that's where a lot of clients, such as those in entertainment, fashion, travel, and financial, are using the opportunity to engage our consumers. The idea here is really to go into more CTV, connected TV types of advertising campaigns. It's basically your TV placement. These placements are likely to work better when a brand is interested in building awareness, either for the brand itself or for the particular seasonal product. Typically, the placements that receive high cost per impressions are the ones that are very high quality, have dedicated eyeballs, and are well targeted, and Uber is only one of those. Not to say this isn't an opportunity, several advertisers have large branding budget, and Uber's scale gives them a clear right to take a piece of the branding pie, and they will. What could further accelerate this opportunity is the creation of more formats that could cleanly tie to the advertiser return of investment and for this company. So what does it mean for Grab? If Uber's path serves as a guide, Grab may only achieve a quarterly operating profit sometime in 2025 or later. While it's difficult to draw firm conclusions because of differences in both businesses, which include the geographies where they operate and how they report their financials, Uber's path to profitability sheds light on what Grab's might look like. Currently focused on pursuing profitability, Grab's revenue in Q1 2023 surged to 130% year-on-year to $525 million. It has also reduced its adjusted losses for the quarter by 77% year-on-year and aims to achieve group adjusted earnings before interest, taxes, depreciation, and amortization, or EBITDA break-even in the fourth quarter of this year. And that's what we have. Thank you so much for sticking around. More episodes coming right up.